Traders, welcome back. Hope you've had a good start to 2022. About to get into things. Another amazing institutional Sunday for you. The number one trading program anywhere, I think, I'm sure you'll agree if you've seen them before. Showing you the stuff that actually drives markets, is going to be driving markets, and cuts the retail BS on the side. So let's focus on the stuff that actually matters. We're going to get straight into this one. We're comparing very briefly Bitcoin, equity market. It's been quite apparent, the complete collapse in Bitcoin I've been noticing in January. It's been completely trounced, right? And we can see here, I mention it time and time again, the correlation between Bitcoin and the S&P. You can see here, so this kind of pinkish line and the black line, so the black line there, you can see both heavy losses throughout the week, mainly driven by sentiment in the equity market and risky assets overall. That's massively impacted Bitcoin. So if you trade Bitcoin and you don't follow this, then I'm afraid you're in for a bit of a rude awakening today, because I'm going to show you that they are completely correlated. You have to know what is going on across the board, even in things like yields. 10-year yields, as you can see here, spiked last week, and this week completely rallied, as in collapsed, around 10 basis points as we saw a flight to safety. So again, if you're trading Bitcoin and you're not aware of these things, then you're in serious trouble. You should have been lightening up on positions well ahead of any of this, because it's been telegraphed for at least 2 to 3 weeks now that the market is obviously moving from a risk appetite towards a risk off sentiment, which we're seeing across the board, right? So you see that all across the board. So just finally, dollar yen, equity market, Bitcoin, yields, and oil is the only one that's holding a little bit more resilient, obviously due to certain situations, geopolitical and situations to do with the energy market, to do with supply side issues, things in the news, etc. So apart from that kind of outlier, everything else just collapsing last week, and we can have a look at that in a little bit more detail actually. If you look here, what we're going to do, I'm going to show you obviously the usual stuff where we talk about the equity market falling off last week, down 5.7%, completely got trounced, right? I mean, Friday, short week with the bank holiday, but actually what I first want to show you, because I'm trying to do a bit more of a Bitcoin piece today, is if you have a look at the equity market over the last, not only last week, over the last few months, right? Since kind of September, October, we've pretty much wiped out all the gains, and we're now complete trouncing last week. Now let's compare that to Bitcoin, and I've put here Shiba Inu as well. So look at Bitcoin, very similar, right? Exactly the same picture. Cannot stress this or repeat this enough. If you see here, this is, so let's actually drag this, quite a useful chart, this one. Let's bring in September, right? So can you see, same thing. Everything from September, October, November has now been wiped out, and more, complete trouncing. It's no coincidence that they've moved exactly the same. You can see that there. And then just finally, let's have a look at Shiba. And I only mention this because I did a video. A lot of people got upset. I don't know what they're on about, to be honest. Clearly haven't got a clue when it comes to trading. You go and have a look at my December video. I said, get the hell out of this thing. Complete waste of time being in this. Forget your squiggly lines and your silly little Fibonacci's that said it was going to bounce around here. You've got to be honest. That's what all the videos on YouTube were saying, that this was some sort of, I don't know what it was, down here and here, and there was some sort of bounce, and we're going to bounce here, and I've never heard something. We should be on some sort of children's program, all of that nonsense, right? Let's be honest here. What's actually happened is complete trouncing, right? As I said in December, and look at it, complete and utter trouncing. Like I said, you can't say, I haven't said all this stuff, don't know why people got so upset. Could see it a mile off, that this was coming. So yeah, like I said, if you're just focusing on those markets and not looking at other factors, which I'm going to highlight to you today, now's a good time to start. Obviously don't want it all to be negative. There's a lot of positive, which is now's a good time for you to start. If you're in cryptocurrencies and you're wondering, hey, where's all this sell-off come from? I'm wondering. Well, here it is. We're going to show you now. So basically, a lot of it is to do with rate sentiment. When it comes to fundamentals, this week there hasn't really been anything. If we look at, I believe I've got the calendar here, you can see a dead calendar. No high impact news. A little bit of housing data on Thursday. Really wanted to put no data of note every day, but we had housing data on Thursday. So I've just put that in there, but it didn't really impact the market. It was a bit of a mixed data. I'll leave you to go and kind of check out what permits were and home sales, and I don't want to get into it because it was very mixed. Some positives, some negatives, kind of netted each other out. However, what actually happened is heavy sentiment really started to pick up towards middle of the week, going into Thursday. Market just started to really unwind, and I think that's where a lot of it was driven from. Was it's basically rates hitting I think it was 1.85 or 1.9% in the 10-year, the highest since January 2020. Really spooked the market for some reason. I believe there was more to it because rates have been rising a lot over the last few weeks. I've been flagging this many times in the previous Institutional Sunday. So I believe there was a little bit more to it. Some of it was the obviously Russia-Ukraine situation. Basically, my point is a lot of the sell-off that's been happening in the equity market has been driven by non-data calendar items. I think some of it was geopolitical, and then just the risk-off sentiment from this rate rises. So I'm going to come back to this in a second, but I just want to jump ahead a little bit to the rate picture. So you can see here, markets rate hike expectations just keeps increasing. There were some rumors during the week of a 50 basis point potential hike at the next Fed meeting. Okay, so let's think about it. When is the next Fed meeting? Well, there's one next week. Okay, so sorry, the 50 basis point potential hike rumors were about the March meeting, but there's a lot of anxiousness in the market that at this meeting next week in January, they're going to announce a potential 50 basis point hike, right, at March. Not very high probability of it, but even some talk of it now. I think that spooked the market. Okay, so let's just go and summarize very quickly here. What actually drove this? Bitcoin selling off and everything selling off, even Forex, dollar, yen, pound, yen, everything, tanking. A is 10-year yields, which intraday anyway hit recent highs, right? B is geopolitical, so Russia, Ukraine. It's obviously quite a scary thing, right? Very serious thing. I think we're seeing Russian troops now lining up on the border. It's no joking matter, enough to spook the markets. And then finally 50 basis points in March. Okay, now I don't mean to offend anyone, but if you're following Bitcoin, you've got Bitcoin in your portfolio and you're not aware of these things, you've got to really ask yourself whether you're a serious investor or you're just messing about. And it's fine if you're not into these things, because that's why we're here, to learn, right? So start following these things, start reading about these things, because they're very, very much in big institutional investors' minds who are starting to lighten up their portfolios, which is what's causing the sell-off. Just going to have a look at this now. So let's actually look at what kind of sell-off we saw. What was the magnitude? Well, it was decent. So 5.7%, big sell-off, right? Every day, Tuesday, Wednesday, Thursday, Friday. I think 2.5% the week before and 0.5% in the first week of January, which means we're now down 8.3%. And where was most of that driven? Very interesting to see that a majority of that is here, tech and real estate. I talked about this last week already. You can see it here, 8.3%, already down over 5%. Last year we had 1.5% correction. This year we've already had not only a 5%, but we're getting towards 10% corrective territory. So nothing to obviously be too alarmed about, but we're already starting to see a shift in mood this year versus last year. Completely different environment, and most of that coming from the tech sector. So I think Nasdaq was down over 10% intraday at one stage, 10% intraday. So I think that also played a part. So I put the three things, probably should have added that as the fourth thing. Nasdaq being down 10%, which suggests there is a lot of concern about how hawkish the Fed might be, right, going into the next meeting. I'm going to leave this January personal performance. You guys know I'm up $18,000. I showed my live account in my last video. Go and check out my last video. I'll put the link at the end. I'm going to leave this now because I want to keep it quite short. Let's really talk about this worries about rate hikes, because that's where I want to finish off, just going into kind of what to expect next week. So next week, we're not expecting rate hikes next week, but we're expecting a change in language, right? And what happened in October 15, just before the first hike and the tightening cycle there started, is they did change the language a little bit and specify, in determining whether it's blah 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 appropriate to raise the target rate at its next meeting. So we'll see at January meeting next week. Will they use these words, next meeting? Will they actually signal to the market that something's going to happen in March? I think there's the risk, basically, right now, what's priced in, that they are going to have one hike. So if they say, yes, there's going to be a hike, I don't think it's going to be a shock to the market. In fact, we might see a relief rally next week. I think the risk is twofold. One, that they're way more aggressive, and start to signal, they're not going to say 50 basis points. Obviously, that's a big risk for the March meeting in itself. But they could be very much more hawkish in their tone, but unlikely. I think this is kind of the pitch they're going to take, where they'll probably just signal one hike. The risk more I see is that they don't do this, okay? And Powell kind of leaves himself a little bit of room not to hike. And there we might see a big rally in the stock market, because clearly the stock market doesn't like this tightening stance that the Fed is taking. That's why we've seen the market off 8%, right? And we can see that here. Rate hikes may cause equity market volatility, and very clear. Preceding the first rate hike, as in before, we don't tend to see that many corrections, and we've seen that, right? We just saw one correction last year. But after the rate hike, we tend to see a lot of corrections, because obviously the market realizes we're on this rate hiking path. There's going to be headwinds coming in. So in the first 12 months on average, tend to see 3 or 4 corrections of 5%. So basically volatility, right? We're expecting some volatility to happen no matter what. We are pricing in 7 rate hikes over the next 2 years. Not to scare anyone, but I've already said this already. End of the day, we are still at historically low rates, so it's not anything to be alarmed about. But the point is, it is going to cause some headwinds. But again, to repeat, the risk, right? I think for the market, and I guess you could not call it a risk because it's probably going to cause the market to rally, is that they don't signal a rate hike. So be very closely watching the language next week. But at the moment, obviously the market is worried about rate hikes, and that's why we're seeing quite a negative sentiment throughout the plays. There's worries of this 50 basis point hike. You can see it here. So whole attention will be on that. There is some GDP data. I don't think the market's going to be too focused on that. Obviously, we're expecting some decent punchy rates of about 5.3%. So really nothing to be too alarmed about. Final thing on the plus side is, to counter this kind of negative sentiment we're seeing from rates, is Omicron. Rates are coming off. So you can see the UK rates there, the South Africa rates have completely collapsed. The US is starting to see a little bit of a turnaround in rates. Initially this spike, believe it or not, I found this data from OpenTable about restaurant bookings. So restaurant bookings had actually gone back up to around pre-COVID levels, as things were getting better. But then the spike in Omicron have caused bookings to come off, have caused air travel to come off. So this will be interesting to see if we start to see some recovery in these back up as Omicron rates come off. Earnings also bang in line, maybe not the crazy numbers we were seeing in 2021, but 2021, but still decent earnings, very strong earnings. So on the positive side, actually Omicron may be a positive now as it eases off. Earnings positive, earnings and negative rates. Okay, so these things are fighting each other. Okay, for the next week, we'll see what the market focuses on. Okay, will it focus on rates? Will it as a negative? Will it focus on Omicron and earnings next week? We'll see. If you're following Bitcoin, you need to know about this stuff. Watch Institutional Sundays, the only place you're gonna see it. You can watch other stuff, but then I don't know, you may as well watch a Lamborghini channel. Okay, that's not what we're about here. Click the button to subscribe. Watch this video, as I mentioned, if you want to see my January performance plus $18,000. Have a brilliant week. See you next week.